What if I told you that a technical setup just triggered and historically it resulted in an average equity return of 125%? This isn't theory, it's history. When the Nifty-to-Gold ratio enters its most oversold technical setup, a pattern we have only seen thrice in the last 25 years, it has previously unleashed stock market bulls. Now, we're talking rallies of 137% in 21 months and 147% in 19 months. And as of September 2025, the ratio has fallen to a 5-year low and it's trading near 2008 levels. Welcome to today's exploration of two fascinating market ratios, the Nifty-to-Gold ratio and the gold-silver ratio. Now, what we're going to do is that we'll unpack what these ratios are, why they matter to investors, and this will help us predict whether stocks are about to soar or if gold's safe haven status is about to fade. By the end of this video, you'll understand why some analysts believe equities currently hold more promise than gold, while others point to opportunities in precious metals. Imagine that you have two scales. On one side, you have India's stock market represented by the Nifty 50 index. On the other side is gold, and gold is of course a very time-tested store of value. The Nifty 50 ratio tells you how many grams of gold are needed to buy 1 unit of the Nifty 50. It's calculated very simply as Nifty 50 index level divided by the gold price per gram. Now, when this ratio falls, gold is outperforming stocks. When it rises, equities are on a roll. However, investors use this as a mean reverting signal. Like when the Nifty to gold ratio reaches around 2x, two things are happening. Bull run in gold and investors predicting that in the years to come, equity remains a sweet spot compared to gold. And what is more interesting in September 25 is that it fell to a 5-year low and trading around 2008 levels. Now, the ratio's history is marked by, a few dramatic swings here. Now, previous downsides of this ratio also tell us a story. Let's go back in time. Now, after the ratio bottomed in February 2009, August 2011, and March 2020, the Nifty rallied around 137%, 93%, and 147% within a couple of years. Now, history suggests in May 2003, the ratio hit 2.6 and the Nifty surged around 180% over the next 4.5 years. In August 2011, the index climbed roughly 190% over nearly 4 years. And the following May 2020's pandemic low, the Nifty jumped about 104% in just 1.3 years. Why do these reversals happen? Now, to understand, think about the relationship between gold and stocks. Now, there's an academic study on Indian markets that found that gold and stock returns barely correlated. The correlation between gold and the Sensex was only about 0.071, while with the Nifty, it was 0.069. Now, that means that gold often moves independently of equity. Now, during crises, gold prices tend to rise while stocks fall, causing the Nifty to gold ratio to drop. Now, as confidence starts coming back, equities rebound and the ratio climbs. Now, gold's hedge role was on full display during the COVID-19 pandemic and in the 2022 market correction. And the ratio helps us understand even when to increase allocation to gold and reduce from equities. Like whenever the ratio has crossed 4x or above, gold has also given decent returns. Historically, the ratio has shown that whenever the ratio has gone over 4, the next 3 years' performance of gold has been phenomenal, as you can see in this table, which means one thinks of increasing their allocation towards gold whenever the ratio goes above 4. Now let's turn to another ratio of the day, the gold-silver ratio. Now this measures how many units of silver you need to buy 1 unit of gold. For example, if the gold-silver ratio is currently 70:1, one would be able to purchase 70 grams of silver to 1 gram of gold. Historically, it's hovered around 47 to 50 during the 20th century. Two dramatic events illustrate the extremes. Now, during the silver bubble of April 2011, the ratio plunged to around 31:1, signaling silver's outperformance. Conversely, during the COVID panic of March 2020, it spiked to around 123:1 as silver prices collapsed relative to gold. Now, studies suggest that when the ratio rises above 80:1 or falls below 40:1, it eventually drifts back towards the mean. Now, silver cycles are rarer but more dramatic than gold. Now, research comparing the two metals since 1999 has found that silver is roughly 1.5 to 2 times as volatile as gold. Now, silver prices depend heavily on industrial demand, think solar panels and electronics, whereas gold's demand is more investment driven. And as a result, Silver tends to lag at the start of a metals bull market and then surges later, compressing the gold-silver ratio. For example, the ratio peaked above 100 during the 1991 and 2020 crises, and silver prices outpaced gold the following 6 to 24 months. So how can these ratios help you? Think of them as thermometers for market sentiment rather than crystal ball. When the Nifty-to-Gold ratio stands depressed, investors must look for equity, and when it's 4 and above, investors must allocate to gold. Now, the gold-silver ratio, that also works similarly. A high reading above 80 implies silver may be undervalued relative to gold, and a low reading below 40 suggests gold is undervalued. Now, because silver is more volatile, allocations should also reflect your risk tolerance. Now, research is also noting that gold's annual return volatility is around 18 to 20%, whereas silver's is around 30 to 35%. For Indian investors, one practical approach is to monitor these ratios and adjust your portfolio allocation rather than making binary bets. For example, if the Nifty-to-Gold ratio falls to a 5-year low and begins to turn up, you might gradually increase exposure to equities. If the gold-silver ratio surges above 90 and then starts declining, consider adding a small allocation to silver if you have access to silver ETFs or even physical silver. Always combine these signals with macro indicators like interest rates, inflations, and even corporate earnings. Now, the Nifty to gold and the gold to silver ratios are powerful lenses through which to view the market cycle. Now, they remind us that markets move in waves. You have fear that drives investors into gold, and optimism fuels equities, and silver, it dances to its own beat, often late, but sometimes very spectacularly. Now, use these ratios as guides, not gospel. Diversify across assets, stay informed across macroeconomic shifts, and remember, patience wins in investing. What are your thoughts? Let us know in the comments below, and thank you for watching this edition of Bottom Line.